Well, I think once a decade, there's a budget that really comes along and really changes the operating dynamics of the Australian economy. And we only have to look back to the budget of 1988 with the return to surplus, 1996 with spending cuts, and 2000, of course, with the GST. And they were budgets which really changed the operating dynamics of the Australian economy. And I tend to think the FY15 budget is going to join that list because it really ushers in a new era of Australia, of smaller government, more infrastructure spending, and of course less dependency for household income on government payments. So I tend to think this budget is actually a game changer, and the government's already announced $36 billion worth of savings, but I tend to think the more important dynamic is the long-term build-up of government debt, and the deficit looks to be on a more sustainable path. So I look at this budget and I'm pretty happy at the moment. The end of the FY14 financial year, we have a deficit of around 50 billion. Now, in the following 4 years, that's going to progressively slow down to 30 billion, then 17, then 10 and 2. But to me, I tend to think that the assumptions in the budget are pretty conservative, particularly on the growth numbers. And when you actually look at it, the economy doesn't return to an above trend pace of growth until FY18. That's a long way away. And the mining investment cliff to me actually something which is going to come and go probably in the next 18 months. So once that's gone and we get the export boom from all of these mining investment projects, I tend to think economic growth is going to surprise on the upside. And that tends to suggest to me that we might get a surprise return to surplus much earlier than the government estimates. Well, if you have to sum up one group who was the true winner in the FY15 budget, it was business. And we only have to look at the large infrastructure spending programs that have been initiated, the tax cuts for small business, investment banks and law firms are going to obviously benefit from the privatisations for government corporations, and of course the establishment of a $20 billion medical research endowment fund is certainly going to support activity there. Probably the big losers are the consumers. Motorists are going to be paying more. Petrol excise, about 1 cent a litre each year. We're going to have co-payments when we get sick and we go to the doctors. Higher income earners get hit with a deficit levy. Middle income earners have eligibility tightening for welfare payments. And at the same time, there's cuts in health and education. So in the end, the business sector are the big winners, and that's important because they're the long-term wealth creators, they're the employers in the country, so really they're the primary source of government revenue. And it really just reverses the historic trend we've seen over the past 15 years, during which households have been the massive winners. Probably the big impact on the markets is the fact that I tend to think that the small amount of fiscal consolidation we get in 2014 is probably going to mean the RBA won't be increasing interest rates to next year. And of course, the fact that we have a lower debt build-up, better deficits, I think that's a very positive impact on the Australian government bond market and also our AAA credit rating. Now, of course, from an equity perspective, there are more winners and losers, and probably the big winners are going to be the infrastructure developers. There's some pretty big government programs, both state and federal. That's going to be very supportive and constructive for their earnings outlook. You know, there are some tax decreases for small business, but that won't really have a market impact. But I tend to think that other sectors are probably going to weigh, so we could get a bit more pressure in the health system. Probably the benefits of the infrastructure are going to be offset by a more difficult trading environment, perhaps for consumer stocks. Clearly, this budget's going to weigh on consumer sentiment, and the real issue for the government and really the RBA is whether the weighing of sentiment then actually leads to a precautionary rise of savings and consumers pretty much putting their wallets away. If that actually transpires over the next 3 to 4 months, then of course there could be downside risk for consumer stocks. But overall, I tend to think it's something that eventually will be constructive for the economy and for the share market, but the impact of that is probably going to be more felt in the long run.